You know that feeling when everyone around you is talking about stocks? Your coworker, your cousin, some guy in your Instagram comments? And they keep throwing around words like short squeeze, P/E ratio, and buying on margin. And you just nod like you totally get it? You don't. And here's the uncomfortable reality. Neither do most of them. A FINRA study found the average investor answers fewer than half of basic investing quiz questions correctly. And the terms they get wrong most often? The exact ones they're using to make real financial decisions. Today, we're fixing that. Every major stock market term. Plain English. No condescension. By the end of this video, you'll understand more about how the market actually works than most people who've been investing for years. The basics. What you're actually buying. Let's start with the absolute foundation. A stock is ownership in a company. When you buy a stock, you become a part owner of that business. Think of a company like a pizza cut into millions of slices. Buying a stock means buying one slice. As the pizza gets bigger, as the company grows, your slice becomes more valuable. A share is just one unit of that ownership. Stock is the general concept. Share is the thing you're literally counting. This is where most people make their first big mistake. They assume a cheaper share price means a worse company. It doesn't. A stock trading at $8 per share, with 10 billion shares outstanding, has a total value of $80 billion. A stock at $900 per share, with only 1 million shares, is worth $900 million. The price per share tells you almost nothing on its own. Here's the thing about dividends. A lot of people treat them like free money. They're not. A dividend is a cash payment a company sends you from its profits. But here's what nobody talks about. When a company pays out a $1 dividend, its share price typically drops by roughly $1 on the same day. Your total wealth hasn't increased. It just shifted from being locked in the stock to being cash in your hand. Dividends aren't bonuses. They're redistributions, and they're never guaranteed. Disney eliminated theirs entirely in 2020. Market structure, indexes, ETFs, and mutual funds. Now, here's where it gets interesting. An index is a curated list of stocks used as a scoreboard for a part of the market. The S&P 500 tracks roughly 500 of America's largest companies. The Dow Jones follows just 30. Think of the S&P 500 as the class GPA, one number summarizing how hundreds of corporate students are performing together. Here's the catch. You can't actually buy an index directly. It's a calculation, not a product. What you can buy is an ETF, an exchange-traded fund. An ETF bundles a whole basket of stocks into one thing you can buy and sell like a regular stock. Buying an S&P 500 ETF is like ordering a combo meal instead of going to 500 different restaurants. Instant diversification. One purchase, low fees. The misconception that gets people burned? Not all ETFs are safe. Some ETFs are leveraged. They amplify your gains and losses by 2 times or 3 times. Read what you're buying before you buy it. A mutual fund does something similar. Pools money from many investors into a professionally managed portfolio. Here's the uncomfortable reality the financial industry doesn't want you to hear. Most actively managed mutual funds underperform the plain index they're compared against over 10 or more years. You're paying higher fees for worse results. Your parents' generation was sold on mutual funds as the sophisticated choice. The data says otherwise. Bull market, bear market. You've heard these constantly. A bull market means prices have risen 20% or more from a recent low. A bear market means they've dropped 20% or more from a recent high. Remember it this way. A bull thrusts its horns upward. A bear swipes its claws downward. The most important thing to know is what happens to people in bear markets. They panic sell, and the math is brutal. Missing just the 10 best trading days over 25 years can cut your returns nearly in half. Most of those best days happen immediately after the worst days. Panic selling is how average investors turn temporary losses into permanent ones. Before I go on to the next terms, make sure to subscribe if you want more videos like this. Trading mechanics. the hidden costs nobody explains. Let me show you exactly how trading works under the hood, because this is where average investors quietly lose money every single time they trade. The bid/ask spread. Every stock has two prices: the bid, what buyers will pay, and the ask, what sellers want. If the bid is $50 and the ask is $50.08, that 8 cents gap is the spread. Think of a pawn shop. They'll buy your guitar for $800 and sell it for $900. That $100 difference is their built-in profit. Even with zero commission brokers, you pay the spread on every single trade. Buy at $50.08 and sell immediately at $50, and you've already lost 8 cents per share before the stock moves an inch. Volume is just how many shares traded in a given day. High volume means lots of activity. Low volume means quiet. Here's what people get wrong. High volume doesn't mean the price is going up. It just means people are trading heavily. In either direction, stocks crash on high volume just as often as they surge. Liquidity is how quickly you can sell something without tanking its price. A popular large-cap stock is like selling a $20 bill. Instant, painless. A thinly traded small-cap stock is like trying to sell a rare antique on a Tuesday afternoon. Even long-term investors need to care about liquidity. If you ever need to sell in an emergency, an illiquid position can force you to accept a price far below what it's worth. Market orders versus limit orders. A market order says buy or sell right now at whatever price exists. A limit order says only buy or sell at this specific price or better. Here's the real-world danger of market orders that most beginners learn the hard way. In a fast-moving or thinly traded stock, you might click buy at $10 and actually get filled at $10.40. That's called slippage. On small, volatile stocks, it can be significant. A limit order protects you from that. You either get the price you want, or the trade simply doesn't happen. Valuation. Figuring out what a stock is actually worth. Think about it this way. Buying a stock without understanding valuation is like buying a house without knowing what houses in that neighborhood normally sell for. You might get lucky, or you might drastically overpay. The PE, price to earnings, is the most widely used valuation tool. It tells you how much investors are paying for every dollar of profit a company makes. Stock price divided by earnings per share. If a stock costs $100 and earns $5 per share, the PE is 20. Think of it like buying a fruit tree. The PE ratio asks how many years of fruit harvests it would take just to pay back what you spent. The misconception that burns people. A low PE doesn't automatically mean a bargain. It might mean the company's future looks terrible. A low PE can be a value trap just as easily as an opportunity. Market cap. Market capitalization is just share price multiplied by total shares outstanding. It tells you the total dollar value the market assigns to a company right now. Under $2 billion is small cap. Between $2 and $10 billion is mid cap. Over $10 billion is large cap. Critical thing, market cap tells you what investors are currently paying, not necessarily what the company is actually worth. During the 2021 meme stock frenzy, GameStop's market cap exploded, with zero change in the actual business. Intrinsic value is the estimate of what a stock is truly worth based on its earnings, growth potential, and future cash flows, regardless of what the market is currently paying. Imagine spotting a painting at a yard sale tagged at $50, but you recognize the artist and believe it's worth $500. That $500 is your intrinsic value estimate. The $50 tag is the market price. Warren Buffett put it simply, price is what you pay, value is what you get. The caveat, intrinsic value is always an estimate. Two smart people can look at the same company and calculate very different numbers. That's why serious investors use a margin of safety, only buying when the price sits well below their estimate. Risk terms, volatility, beta, and diversification. Your brain is working against you when markets get volatile, and understanding why matters as much as understanding the terms themselves. Volatility measures how much and how quickly a stock's price swings. Think of driving. A smooth highway is low volatility. A winding mountain road in a storm with no guardrails is high volatility. Both roads can reach the same destination, but one severely tests your composure. Here's what people misunderstand. Volatility measures movement in both directions. A stock that gains 10% one day and loses 8% the next is volatile. Volatile doesn't mean bad. It means unpredictable. Beta measures how much a stock tends to move compared to the overall market. The market itself has a beta of 1.0. A stock with a beta of 1.5 typically moves 50% more than the market, up or down. Think of the market as an ocean, and beta as how your boat responds to waves. A heavy yacht barely notices the chop. A lightweight speedboat gets thrown around twice as hard. High beta is not better performance. It's amplified exposure to both gains and losses. Diversification means spreading your investments so one disaster doesn't sink everything. But here's where most people completely mess this up. Owning 20 different tech stocks is not diversification. Stocks in the same sector tend to crash together. True diversification spans different industries, company sizes, and geographies. Diversification reduces company-specific risk, but cannot eliminate broader market risk from recessions, rate hikes, or a global crisis hitting everything at once. The advanced stuff. Options, margin, shorts, and IPOs. I know these sound intimidating, but I'm going to explain each one so clearly that you'll wonder why you were ever confused. An option is a contract giving you the right, but not the obligation, to buy or sell a stock at a specific price before a specific date. A call option gives the right to buy. A put option gives the right to sell. Imagine paying a dealership $200 for the right to buy a limited edition car at $30,000 anytime in the next month. If the car's value shoots to $50,000, you exercise the option and pocket the difference. If the value drops, you walk away losing only your $200. Options were designed as risk management tools. The danger is using them without understanding what you're doing. Short selling is betting against a stock. You borrow shares from your broker, sell them immediately at today's price, then buy them back when the price hopefully drops, and return them, pocketing the difference. It's buy low, sell high, done in reverse order. Here's the risk that only 23% of investors in FINRA's survey could correctly explain. Losses are theoretically unlimited. When you buy a stock, normally, the worst case is you lose 100%. When you're short, there's no ceiling on how high a stock can go. Short at $50, and if it runs to $500, you lose $450 per share. This is not a beginner's strategy. A short squeeze is what happens when a heavily shorted stock suddenly surges. Short sellers, facing mounting losses, are forced to buy shares to cut their losses. Their buying pushes the price higher. More short sellers panic and buy. Chain reaction. GameStop in January 2021 went from around $17 to over $300 in days, obliterating hedge funds with large short positions. Here's the part that will blow your mind. If you're reading about a short squeeze on social media, you're almost certainly already too late. The biggest gains happen before the story goes mainstream. Margin means borrowing money from your broker to buy more stock than you can afford with cash alone. Put in $5,000, borrow another $5,000, and you control $10,000 worth of stock. Leverage amplifies gains when things go right and amplifies losses when things go wrong. FINRA found that 75% of investors who actively trade on margin can't correctly define what margin is. A margin call, where your broker demands you deposit more money or they sell your positions immediately, can force you to lock in losses at the absolute worst moment. An IPO, initial public offering, is when a private company sells shares to the public for the first time. Before the IPO, only founders and private investors own the company. After it, anyone can buy in. The myth: IPOs are easy money. Uber, Lyft, Snapchat all lost massive value in the months after going public. The excitement surrounding an IPO often drives the initial price well above what the company is actually worth. By the time regular investors can buy in, the sophisticated money has often already made its move. So, there you have it. Every major term the market throws at you. Subscribe for more videos like this.